Hello, and thank you for joining us today for our session on unlocking value in private companies as part of our Private Markets Academy. My name is Doug Maynor, and I am a managing director in the primaries and co-investments business at Neuberger Berman Private Markets. And over the course of the next hour, we're going to spend time discussing the overall private equity market in the context of three structural advantages that we see within private equity: on the buy, during the hold, and on the sell. And we'll spend a considerable amount of time discussing each of these, going through some of the market dynamics that private equity firms are investing within, some of the history and where we are in today's market, and really spending time on where private equity firms focus in each of these areas that we believe drive meaningful outperformance over the long term within the private markets. So private equity, as you may know, really generates value through active ownership. It is patient capital that invests over the long term, typically focused on companies that are smaller than we see in the public domain, and where considerable value can be added through the influence that they have. So today's session will focus primarily on the buyout market, although many of these same themes will apply across other areas of private market investing. So each of these areas, first on the buy, private equity managers can benefit from access to private information, use of unique financing structures, and less efficient markets overall to really drive value in terms of the diligence that they can conduct at the time that they buy a company, and then creating a situation where they're set up well for the long term to add value during their holding period. Now, on the hold, this active ownership is quite unique just in terms of the influence that PE managers can have to positively influence both the top line and the bottom line for the companies that they own. This comes through very active involvement at the board level and with management, helping to facilitate M&A for growth as well as other organic growth initiatives. And we'll discuss some of the key drivers and levers that private equity firms will pull, both historically as well as in today's market environment and going forward. And lastly, on the sell, seeing as private equity is patient capital that holds companies for the long term, they have the ability to wait and pick the right time to exit a company, but not only the right time, but the way in which to exit that holding. And we'll discuss some of the history and the dynamics of the exit environment and how positioning the company appropriately can really drive value for investors. So in this first section, we'll spend time talking about the broader environment in terms of on the buy. Now, first, let's distinguish how private equity is different from public stocks. So in the public market, clearly it's very efficient. Investors have access to the same information, whereas in the private equity markets, typically companies are bought through a long diligence process. So you have unique access to private information, significant time to diligence the company, not only meeting with management team, but visiting offices, manufacturing facilities, speaking with customers, and using that information to help guide both the purchase price, but also the value creation plan once you invest in a company. Use of financing structures are quite different. Within the private markets, there's a number of different forms that you'll see, both the use of equity, mezzanine capital, and debt to purchase a company. But we'll also speak within the broader environment how private equity firms may pursue minority stakes and other opportunities to access private companies. Overall, this is a much less efficient market. Many private equity firms will spend considerable time researching the sectors in which they invest, meeting with management teams, and really building out a target list of companies that they want to track and to monitor. And in addition, there's a number of intermediaries within the private markets. Many companies will often work with an advisor during a sell-side process, but each of this offers valuable time and resources to conduct diligence that's quite different from the efficient market within the public environment. So let's start by discussing a little bit of the history in terms of what we've seen in the private equity market as it continues to grow. On this page here, you'll see global private equity capital invested and deal count over the past roughly 15 years. Now, coming out of the global financial crisis, we've seen private equity capital investment increase pretty consistently up until the time of COVID. Now, in 2020, we saw a significant slowdown in terms of deal volume and capital invested, particularly in the first half of the year. Although in the second half of 2020, throughout 2021, and even the early parts of 2022, there was a significant uptick in private capital investment as we saw a very low rate environment, significant capital put to work in private companies. In fact, from 2020 to 2021, the amount of capital invested effectively doubled. Now, as the broader environment has changed and interest rates have increased over the past couple of years, we've seen that revert back to more historical norms over the course of 2022 and 2023. In fact, in 2023, the capital invested was down about 40% from the highs that we saw in 2021 and roughly in line with pre-COVID levels. Now, from a deal count perspective, again, we saw significant increase in 2021 after a steady rise in the number of deals over the previous 10 years. Now, the number of deals decreased by a smaller percentage, roughly 20 to 25% over the last 2 years. And it's been more focused on smaller investments. As interest rates have increased and the availability of leverage has been more constrained, we saw more equity invested in many transactions. And just generally speaking, the deals were more focused on upper middle market and below. And we've seen less larger transactions, particularly because credit availability has been a little bit more constrained. Now let's turn to valuations. Now here we see valuations for private equity companies based on purchase price multiples going back to 2007. Now there's a couple of interesting trends that I think it's important to highlight here on this page. This is broken out by purchase price multiples in the US as well as in Europe, which generally speaking have been roughly the same with certain periods where you do see a disparity. I think the first thing to highlight is really the consistent range at which private equity companies have traded hands, generally speaking. Over the past 15 years, you've certainly seen valuation multiples come down a little bit following the global financial crisis and increase during the 2010s as we had a low rate environment and continued growth in the private capital markets. And then over the past couple of years, we've seen purchase price multiples moderate and come down again as interest rates have increased. And we've seen a little bit more normalization in terms of deal activity. But overall, the range or the bound at which you see purchase price multiples generally stays within a pretty narrow band. Overall, we've seen roughly 9 to 12 times purchase price multiples. And I think one of the other interesting things here is if you were to overlay this with the public markets, you see much less volatility. And the reason for that is that private equity firms are investing, again, for the long term. So in the context of a 3, 4, 5, or even 6+ year hold, they want to make sure that the valuation at which they're purchasing is something that is reasonable in the broader context of the market, understanding that it's unknown where valuation multiples may be 4, 5, 6 years down the road when they exit the company. Versus the public markets where you do see much more volatility, just even over the last couple of years in the the pre-COVID and post-COVID environment, we've seen significant volatility in terms of PE or enterprise value to EBITDA multiples for public companies. But in the context of private equity, even though valuations increased over time, particularly during the 2010s, it was a pretty modest, gradual increase in valuations overall, and really driven by certain sectors, particularly those that were higher growth in nature. And we'll talk a little bit more further on in the presentation about how the types of companies that private equity firms are targeting has also affected what kind of makes sense in terms of higher valuation multiples. But again, relatively speaking, fairly narrow band of purchase prices over time. And again, another topic that we'll discuss is the use of leverage, which has generally stayed pretty equal in the post-global financial crisis world. And so this dynamic does affect private equity returns and how those returns are generated, because as purchase price multiples have increased, we've generally seen about the same amount of leverage used on average, which is roughly about 5 times. Now, within the private markets, companies are sourced from a wide variety of sources. And importantly, for any private equity firm, one of their first and foremost goals is to make sure they're seeing the maximum amount of deal flow within either the investment types or the industry sectors that they target. And then really trying to be highly selective in terms of which companies they ultimately decide to bid on or to meet with and ultimately engage in a conversation about a potential long-term investment. One of these areas can be the public markets itself. The public markets over the past 20 plus years have actually seen a decline in the number of listed companies, particularly at the smaller end of the market, roughly 10 billion of enterprise value or market cap or below. For many of these companies, they found that it can be better to operate in the private markets, particularly if they're going through a transformation or a management change. Or in some cases, it may just be that within the public markets, they didn't garner the following, either from a research coverage perspective or public shareholders, to really generate the value that they felt like the company was worth. And so you do see ebbs and flows in terms of public to private activity. On this slide here, you see the private equity take private activity dating back to 2012 over roughly the past 10 years. And each and every year you do see, some amount of volume in terms of take private activity. We saw this increase in 2021 and 2022, partly as there was very significant capital available, but also the disruption that took place in the post-COVID environment. For certain larger private equity firms, public companies became very attractive targets. And we saw roughly 200 billion of take private activity over the course of 2021 and 2022. Now, from a deal count perspective, it's been roughly consistent. So really the ebbs and flows that we see in terms of volume really speaks to the size of companies that are taken private. But it's pretty surprising, actually, just the consistency year by year, where you see roughly kind of 65 to 100 take privates per year across US and Europe. But this is only one source of deal flow for the private equity markets. And in fact, generally speaking, this is really just the target of upper middle market and large cap private equity firms. The vast majority of deals are sourced from very small parts of the market. There are hundreds of thousands of private companies in the marketplace. These may be founder or entrepreneur owned. They could be family owned businesses. In many cases, there are smaller divisions of larger companies that the corporate parent has decided is no longer core or maybe looking to raise cash. So whether it's corporate divestitures, family owned businesses, as well as the venture capital and growth equity market, new companies are constantly being created, and those that grow to a certain size and scale may be looking for new professional capital to help grow and manage the business and really take it to the next level across its life cycle. Now let's talk about within the current outlook for private equity, what are we seeing in terms of the broader market dynamics? And how is this affecting where private equity firms are spending their time and what types of companies that they're seeking? And how this affects us as we think about investing and partnering with private equity firms, particularly across co-investments. So let's start with the broader market and operating environment. As many of you are aware, we've seen a lot of volatility in recent years. There was, massive disruption and changes to the broader marketplace as a result of COVID, initially the economic shutdown, and then some of the changes in consumer buying behavior or how it disrupted supply chains over the years that followed. So as we sit here in 2024, there is a broader environment that is more challenging. We see higher interest costs as we've gone from a zero rate environment to much more significant, steady state, higher interest rates. There's consistent concerns about a recession. Will we have a soft landing or a hard landing? And this is certainly in the minds of private equity investors. Elevated inflation combined with a tight labor market, which has often led to significant compression in terms of margin profiles. Regulatory uncertainty, not only in the US, but in other markets where private equity firms look to invest. Geopolitical tensions, certainly highlighted by what we see going on in Eastern Europe and how that affects companies across the UK and Western Europe. Instability within the banking environment, as we saw a regional banking crisis in 2023, and the real estate turmoil, or at least concerns that investors may have about how that marketplace plays out, as well as disruption or potential opportunities that may come out of the advent of artificial intelligence and how that affects different business models. So in all of this context, it's been more challenging, really highlighted by the higher rate environment and the inflation and concerns that investors may have for the near-term outlook for different businesses. So how is this affecting capital formation? Well, as rates have increased and deal activity has declined over the previous 2 years, it's led to a much more challenging fundraising environment. Many large investors in private equity have consolidated their relationships, investing in fewer private equity firms. At the same time, many investors are seeking out higher distributions from their existing manager relationships in order to free up capital to deploy into new private equity commitments. And there's been much more of a flight to quality over the past couple of years. So for many firms, this has led to either more challenging ability to raise capital or just a longer fundraising cycle in order to bring in the capital that they otherwise were targeting. From a credit perspective, we've seen significant growth in the private credit markets over the past 15 years. They've really become the chief and primary lending source for private equity backed companies, as the banks have really stepped back in terms of their broader lending. We're starting to see that loosen, and banks are certainly coming back in terms of providing leverage financing for private equity capital structures, but being very highly selective in terms of which companies that they're ultimately choosing to lend to. Now, how is this affecting the investing environment? Well, we've definitely seen a pullback in terms of investment activity, and we'll speak about this a little bit more. But over the last couple of years, as you saw in some of the other earlier pages, much less private equity M&A volume. Private equity firms have been more conservative in terms of their underwriting. I think being highly selective in terms of which companies they will target. And the bid-ask spread overall between buyers and sellers widened considerably, particularly beginning in 2022, and that really persisted throughout 2023. What we're seeing currently is that is starting to die down. I think as you get further along in this rate cycle, you get a little bit more clarity or certainty around what the economic environment looks like over the next couple of years. But also at the same time, you do have significant capital that was raised in prior years that is seeking to be deployed. Lastly, companies that may be ripe for sale for the last couple of years and they've been waiting for the right time. There's increasing pressure to generate liquidity for those companies, especially as we said, the fundraising environment becomes more challenging. So this cycle of fundraising, investing, and exiting, we've seen a slowdown because it really is circular in nature. So as exiting slows, fundraising often slows, and investing is slowed as well. Much of this has been healthy. As we saw, there's still considerable amount of deals that are being done, just at a lower level than what we saw in 2021. And there's increasing focus on quality. So the companies that have transacted over the past couple of years generally are well-positioned, high-performing companies. And we've seen those continue to trade at market clearing multiples that are reasonably high. As we saw on a previous slide in terms of purchase price multiples over time, we've seen those moderate over the past couple of years, but there hasn't been a drastic decline or major change in terms of where those valuation multiples are. And generally speaking, for well-positioned, high-performing companies, they're continuing to trade at multiples that are reasonably in line with what we saw in recent years. But the clear focus, which has really been the case for private equity, this has been building for the last 15, 20 plus years, is more and more focused on operational improvement plans. That's really what will drive value during the ownership period. And private equity firms continue to invest in the operating resources that they have, both in-house, but also the network of executives or operating advisors that they can work with externally as well to really help drive top-line growth and profitability during their holding period. So all of this, we think, leads to a very attractive environment in today's market. Given that the bid-ask spread is beginning to narrow, we see naturally more volume of private equity deals that are in discussion, or certainly being shopped by investment banks. But I think the slightly lower level of volume, more conservative underwriting, focus on quality, should overall, we think, produce very attractive, vintage years coming out of a market environment that was much more volatile over the past couple of years. Now, from a liquidity perspective, as we've discussed, exit activity has been down. And this is causing larger limited partners in private equity funds to really push for liquidity. Now, certain firms may be at or above their target allocation. And one way to reduce that is to get additional distributions from their existing investments. So there's a big push for additional liquidity in the market. And so this is leading private equity firms to be more and more creative in terms of how they drive that liquidity. It doesn't have to be an outright sale of a company in order to drive liquidity and get capital back to investors. Within the secondary market, what is defined as GP-led secondaries have continued to increase over the past 10 years to where today they are roughly 50% or more of the market. And this is a situation where private equity firm runs a process to sell one or more assets within their portfolio and drive liquidity for their existing investors while also seeking out capital to continue their value creation plan for another 3 to 5 years. So this is one way to generate liquidity without actually exiting full control of the business. Another way, which is a clear source of focus for us in terms of sourcing deals, is to pursue a minority investment or a midlife partner. So for businesses that are not quite ready for sale, or the private equity firm sees existing or continued value in owning the business, but perhaps would like capital either to pursue additional acquisitions or for a recapitalization, perhaps to provide liquidity for other shareholders, may sell a minority stake or a 50-50 stake in the business while maintaining control and seeking more of a full exit in 2 to 5 years. So these midlife transactions and GP-led secondaries are other ways to generate liquidity. They can lock in returns for high-performing investments without exiting that full control. But overall, liquidity has certainly been at a premium and continues to be that way in today's environment. And later in the presentation, we'll talk a little bit more about distribution trends and where we are today. So let's turn to some of the key underwriting factors that private equity firms will target, and certainly we target when we are conducting diligence on a private equity opportunity. So first, a sound business model with sustainable competitive advantages and low sensitivity to cyclicality. In a word, a good business. Is the product or service that the company provides mission critical? Does it have a reason to exist? And is it well positioned within its market? And are there avenues for continued growth, either in terms of the addressable market or expanding the opportunity set for that particular product or service? Second, multiple and clear options for value creation, which could be through organic business expansion, operational efficiencies, M&A, or other actions. This really comes down to how are you going to add value during the holding period, which is probably the most significant component, and we'll spend considerable time discussing this in the next section. Third, a reasonable investment valuation. It is a competitive market. We do see, for high-performing, well-positioned companies, there are often multiple potential buyers. So it is quite competitive, but you want that valuation to be reasonable in the context of the market in which the company operates, other transactions for similar companies, and importantly, is it a reasonable valuation in terms of once value is created during the holding period, exiting at the same or similar multiple, and is that going to be reasonable? And can that valuation support a capital structure that makes sense for the business? Which leads to our next key underwriting factor, a prudent capital structure. Is there flexibility within the capital structure in terms of the mix of debt and equity, or potentially other mezzanine securities? What is the free cash flow profile of the business? And does it have the flexibility as the rate environment may change to support that capital structure? And how does that impact the overall return profile for the investment? Fifth, an experienced lead sponsor with strong fit within the specific investment opportunities. Now, as mentioned, many private equity firms will specialize in specific industry verticals or geographies or certain types of investments that might be such as a corporate carve-out or a turnaround or more of a minority growth investment. So you want to look for a sponsor who has significant expertise across multiple market cycles in investments that were similar in nature, both either in terms of the value creation plan that's being executed or specific expertise within that industry or certain investment type. Next, a clear exit path. We'll talk about this in our last section, but at the time of investment as you look 4, 5, 6 years down the road, is this a company that a strategic acquirer or another financial sponsor would want to own? Is this a business that you would like to position potentially for a public market exit down the road? So even at the time of entering the company, because it's long-term patient capital, you're already thinking about and want to make sure that this is a business that would have a clear exit path. And again, does it have a reason to exist? Is this a business that another buyer down the road is going to want to own? And lastly, an asymmetric risk reward profile. Now, bringing all of these factors together, ideally at the right valuation, or at least a valuation that's reasonable, with an appropriate capital structure in a good, solid business, ideally one with market tailwinds. Perhaps it's a fragmented market with considerable opportunities for growth through acquisition. All of these can hopefully lead to an asymmetric risk reward profile. So you're underwriting to a reasonable set of expectations in terms of growth, margin improvement, perhaps even strategic M&A. But is there opportunities well above that? And then looking at the downside, can this business withstand market cycles, changes in interest rates, potentially a lower exit multiple, and in doing so, still generate a positive return and one that would make sense for investors? So ideally, low downside risk that can be mitigated by each of these other factors, with opportunities for considerable upside should you be able to outperform in a number of areas. Now, in the context of today's environment, what are some specific things that we, during our diligence, and we see private equity firms watching out for, given the environment that we're in? The first, recession concerns. This really comes down to sensitivities, looking at a business in terms of how it's performed during recessionary periods in the past, and how would the underwriting plan change or be affected, should we have a recession, and particularly how cyclical is the overarching business? How affected do we think it would be by a sudden or significant change in the broader economic outlook? Second, higher interest rates and the implications that has on free cash flow. This is particularly important in today's environment. We do have much higher base interest rates than we had several years ago. Many investors expect those are likely to persist, or at least remain at relatively higher levels than what we saw in the past. So again, does the capital structure that's potentially in place, can it support these higher interest rates, and potentially for a long period of time, or even higher rates if they were to go up? And how does this affect the overall free cash flow of the business? Free cash flow is important as it provides an opportunity either to deleverage the business or invest in future growth, both organically or through acquisitions. And so this is an important thing to watch out for, particularly in the context of the overall valuation for the business and its margin profile. Next, sustainability of inflated top line and profit margins. So coming out of the COVID period, certain businesses and particular industries have seen their top line or their margin increase considerably. And in some cases, that may or may not be sustainable. And that's an important thing as part of diligence. Sectors such as healthcare or e-commerce have seen significant changes in margin profile and demand as the market has stabilized. Stocking and destocking, visibility of end market demand, particularly within consumer products. We've seen this be a big factor as supply chains were disrupted, and some of those supply chain disruptions have unwound. You'd like to do some analysis in terms of how that affects the overall business, and how does it affect the purchase price that you're paying and where that business is likely to go in the coming years. Third, COVID impact on historical financials. And, similarly to the sustainability, certain businesses were impacted either positively or negatively during that period from 2020 to 2022. So analysis of a normalized profile. In some cases, that might be demand that was pulled forward that's affecting the outlook for the business here in the near term. Or in some cases, it may be that the business was very negatively impacted, and perhaps there's additional opportunities that can be sought out, as you're looking at companies now going forward. Wage pressure and labor availability, certainly something that's top of mind for investors. This has margin compression implications, but also the retention rates for different companies in certain industries. If retention rates are low and labor markets are tough, as well as inflation in wages, all of these can be key factors that could either be opportunities or potential risk factors to look out for in an investment. Valuation volatility. As discussed earlier, the public markets have seen very big swings in valuations over recent years. So certain areas such as public to private opportunities, this could be an area where you certainly want to be on guard and make sure that the valuation is appropriate in the broader context of the environment. But even within private companies as well, again, going back to looking more at a steady state, reasonable valuation. And lastly, artificial intelligence. The advent of AI and how it will affect different business models could be a significant disruptor. So we see many private equity firms spending time and research on how this may affect the positioning of a company and its competitive marketplace. Is it something that could be highly disruptive, where new entrants may be able to take share? Or is it a business that is very well positioned to capitalize on AI and perhaps further disrupt their own industry? So bringing all this together, what is our approach in the current environment? So for a lot of the reasons that we discussed, while the environment does merit caution, we remain very positive on the long-term structural advantages of private equity. And there's a number of key areas where we focus. And first and foremost is continuing to expand our sourcing funnel of new opportunities. Now, I mentioned this earlier in the context of private equity firms and having significant deal flow, seeing all the opportunities within the types of investments that they target. And it would be the same for us. The best way to remain highly selective is to see as many opportunities as you possibly can. We do this by building relationships with a number of leading private equity firms and discussing our abilities to partner with them as a co-investor or provide other capital solutions that can be value added. This can dramatically increase your funnel of opportunities and really allow you to be more selective in targeting what we discuss here on the next point, quality assets. Again, businesses that you want to own for the long term, that are well positioned to continue to grow, and also have opportunities for either further M&A or operational improvements. Third, creative investment solutions. So we talked about improving, increasing that funnel of deals. One way to do that is finding creative ways to invest in private companies. Now, certainly the outset of a new transaction is one way to partner with a private equity firm and invest as a co-investor. But other ways are to get actively involved at the outset when PE firms are still competing to win a certain company, and you can serve as a co-underwrite partner. This provides an opportunity for additional time and detailed diligence, which goes back to further increasing the ability to target specific assets Next is, in addition to co-underwriting, serving as a midlife investor. So seeking out companies that a private equity firm already owns that are performing well, but have a capital need, either for liquidity or an acquisition or a recapitalization, and partnering with those companies that a PE firm already knows well as an existing investor, and where additional capital can come in, typically with a slightly shorter hold period. Next, maintaining discipline and high selectivity. Again, in the context of broadening the deal flow funnel, this allows you to reduce the number of opportunities in which you really spend time and focus, and maintaining discipline as you do so. Saying no to the opportunities that aren't a fit quickly, but really spending time and digging in on companies that you do believe are well positioned. Investing behind key long-term growth trends, even just across the broader market. We've seen a shift over time. Private equity firms continue to focus more on what I would say are asset-light businesses that tend to be less cyclical, more service-oriented, and really have long-term secular growth trends that are positive to drive both organic growth, but also continued expansion over time. Prudent portfolio construction and diversification. Again, as you remain selective, also diversifying the portfolio over time across company sizes, sponsors, industries. All of this is important to building a well-balanced portfolio. And on this last column, partnering with premier GPs. Again, private equity firms will focus on specific industries or investment types, and we seek out partners that have experience over multiple market cycles within those key industry sectors and that have a great track record of performance over time, but also a strong network and the operating resources internally and externally to drive value within the companies that they own. Identifying value creation opportunities. During the diligence process, it's one thing to assess the valuation and the capital structure, the overall market in which the company operates, and what you think about the trends within that. But importantly, what is it specifically that the private equity firm is planning to do over the next 3 to 5 years to either grow the top line even faster, improve the margin profile, reposition the business, improve and expand the management team? What is it specifically, and how is that going to drive value 4 or 5 years down the road when we're seeking an exit? And lastly, continued enhancement in people, processes, and systems. All of this is certainly iterative, and we, just as any investor would do, continue to invest behind processes and people and relationships that will help to seek out the best opportunities in the broader market. Now, for the last page in this section, we'd like to talk a little bit about how capital structures are affecting base case returns, and we'll spend even more time on this within the next section of On the Hold. But we'll finish by going back to the valuation trends that we saw over time. So valuation multiples have trended slightly more positive, albeit moderate over time, but we spoke about how the debt within a capital structure has stayed roughly the same. So these higher purchase prices have generally been financed with more equity. And one of the questions that certainly comes up in today's environment is, how do the higher rates of return affect the potential returns within private equity? Now, in this context, companies today and in recent years generally have more equity or structured equity, which would be a mezzanine security within the capital structure, but roughly the same amount of debt. So certainly higher interest rates can constrain the cash flow. But the key driver of return in most private equity investments today tends to be growth. And so for businesses that are lower growth, the capital structure is more important, and those higher rates can certainly impact the free cash flow ability or the ability to delever the investment over time. But with many investments focused more on growth, the higher interest expense is less concerning because the growth of the business is the bigger driver of overall returns, and we'll kind of map this out in the next section. So now let's move on to our second section today, which is the operational value add that private equity firms will focus on during their 4 to 6 year hold period. Now, again, we'll go back comparing this to investing in public stocks, where investors have limited to no ability to affect change. Most investors are passive, very small owners. Even larger investors that may be more activist, it's difficult to really affect change, and it's maybe more of a slight influence in terms of driving change. Compare that to the private equity markets, where the companies have the ability to really think long term. So not managing quarter to quarter, but really thinking about what investments make the most sense to drive value over a 2-year, 3-year, 5-year period to position the company well down the road. And this patient capital, combined with the professional experience, the network, the operating resources of the private equity firm, can really drive significant value. In many cases, this starts with aligning the management team. So operating in the private markets and going back to the structuring of investments, a significant component of that can be really aligning the management team of the business with ownership and incentives, but also using your network to optimize and improve the management of the business as it moves into the next stage of its life cycle. And really focusing on operational improvements and value creation strategies. So before we get into the detail, let's talk a little bit about the market within private equity. What are we seeing in some certain trends, where they are today relative to historical norms? We'll start with hold periods. So I've mentioned a couple of times that generally private equity firms are seeking to hold an investment over a 4 to 6 year period. And we've seen these hold periods actually increase as time has gone on. This looks at data going back to 2015. And it's really just the median hold period of an average investment in a private equity portfolio. And we've seen that increase from a low of about 2.5 years to today, 3.3 years. And just in the broader context, as the capital markets within the private landscape continue to grow, and there's more opportunities to drive value outside of the public market, we've just generally seen private companies either stay private longer or in certain cases have longer hold periods. This has also been disrupted by the environment that we saw in the last 2 years. And we'll speak a little bit down the road in terms of distribution activity. So that certainly caused holding periods to increase a little bit over the last couple of years. So as we look at the share of companies that are held for 5 years or longer, that's where we've seen a considerable increase. Going back to 2018, less than 20% of companies in private equity firm portfolios had been held for more than 5 years. So most companies were exited by year 4 or 5. Today, nearly a third of private equity holdings have been held for more than 5 years. So that reduced exit activity and broader M&A activity over the last couple of years has led to more companies being held for a longer period of time. Now, this is important because once a firm has, reached that type of ownership period, private equity firms need to be well positioned to continue to add value in other ways. In many cases, there's transformational change that really takes place during the first 18 months to 3 years of ownership. And then the company reaches more of a steady state or may be positioned for sale to the next owner. But as companies are being held longer, it's important to continue to invest in operating resources. And again, this goes back to buying companies that are well positioned for the long term, because if it may be held longer than that 4 to 5 year period, you'd want that to be in a business that can withstand broader cycles and ultimately be positioned down the road. So now let's spend time on the drivers of private equity returns during the hold period. This is particularly important. We've identified 7 factors that are the key value creation levers within private equity. And we've ranked them here from more skills-based levers to more market-based levers. And in today's environment, it's certainly shifted in terms of the overall importance. Each of these levers can be an important driver to value creation and returns over time. But in the broader market context, we expect the skills-based levers to be those that are more all-weather in nature and will persist over time, and really the ones that will drive higher dispersion of performance between strong performing managers and weaker performing managers. So the first is investment selection. This kind of goes back to the broader theme of selectivity and picking really good companies. This is perhaps the most important. And again, bringing together the factors that affect the buying decision and the diligence process, as well as focusing on companies where a firm can really add value over time. This, ranks at the top of our skills-based levers. This is, again, picking a good, well-positioned company with great management team, well-positioned product or service, competitive advantages that will persist over time, those that are mission critical and really important to their customer base. Number 2, selecting and incentivizing management. So again, a firm that has really great leadership, if that leadership is already in place, making sure it's properly incentivized to continue to drive value. One of the areas that PE firms bring a lot of value is in that professional expertise and the network that they have from prior experience to supplement the existing management team that's in place to really drive the business going forward and have that step function change in improvement. Third, supporting growth with capital or resources. So we've spoken about how private equity firms continue to invest in the operating capabilities that they have in-house, and importantly, addressing upfront where those will be employed to drive value during the initial periods of ownership. So again, going back to investment selection and combining that with the unique operating resources that a firm may have, or supporting growth and really choosing the appropriate places to invest capital for organic growth going forward. This could be, product expansion, focused R&D, geographic expansion, but really putting time and thought and effort and having that pattern recognition and experience to know where capital or resources can be most effective. Fourth, operational efficiencies. So many companies that are well positioned will have an inherent amount of operating leverage as they continue to grow, finding ways to make those businesses run better. Going back to the previous point, putting capital towards the most effective means in terms of either go-to-market strategies or supply chain, a number of areas that can incrementally increase the margin profile and the profitability of the business during the course of ownership. Fifth, as we move towards the more market-based levers of private equity return generation, is M&A. Now, M&A during the course of ownership can take a couple of different forms. We believe that highly strategic M&A, where 1 + 1 can truly equal 3, will continue to be very important. And even in a higher rate environment, that type of strategic M&A or perhaps tuck-in acquisitions of existing products or services that positions the company better and can complement the existing profile will continue to be really important. And even in a higher rate environment, those can be a more skill-based lever to drive significant value. And in many cases, those aren't in the underwritten base case because it's uncertain if you may be able to do that strategic M&A versus the more market-based M&A, which we tend to see as more of a roll-up strategy or buying companies with debt just to expand the business. We do think in today's environment with higher rates, that's less likely to be a driver of returns. It's more difficult to execute given the rate environment and just may not make as much sense or not be palatable within the capital structure of the business. And lastly, in the last two, we have cash flow generation and debt pay down. This tends to be driven by where rates are. So as rates have increased, and we talked about how that compresses free cash flow, we generally will see debt pay down as less of a value driver than we saw in the 2010s, for instance. And lastly, multiple expansion. This is a variable that at the time of investment, certainly it's less known where multiples will be 4, 5, 6 years down the road. And over the course of the 2010s, we saw, significant value creation that often came simply from repositioning a company, continuing to grow it, but then being able to sell it at a much higher multiple than where it was originally transacted. And much of this was driven by lower rates and gradually rising prices, not only in the private markets, but also, as we saw, in the public markets. So in the current environment, we believe that the skills and selection-based tools are most effective in driving value creation. These are more all-weather in nature and will continue to persist regardless of the broader macro environment or the rate environment. But the market-based factors, such as cash flow generation, debt pay down, multiple expansion, can no longer be relied upon or certainly should not be in the base case to generate positive performance. So bringing all this together and going back again to where we focused in today's environment, it's a bottoms-up approach, selecting investments truly on a company-by-company basis, partnering with high-quality private equity firms in their core areas of expertise is going to be the most effective strategy in today's environment. And we also think that the reduction of some of these market-based factors will lead to a broader dispersion and really prove out the best performing, most well-positioned private equity companies and firms that own those companies. Okay, so let's see how these different factors really blend into an illustration of value creation bridge during a hold. So here we've taken a composite of co-investment deal flow that we've seen in recent years and looked at what are the key factors that bridge the value from entry to exit, and what are those primary drivers in the context of the value creation levers that we just discussed. And not surprisingly, for all the reasons that we reviewed, top line and bottom line growth is driving or expected to drive nearly all of the value creation during what's typically underwritten as a 5-year holding period. So in this composite, and certainly what we've seen in co-investment transactions that we've pursued, is really focused on well-positioned companies with PE firms that can continue to drive that revenue and EBITDA growth, which is 93% of the value creation. Now, M&A, which is in many cases not underwritten or may only be the strategic tuck-in acquisitions that we discussed, is a smaller driver, roughly 17% of the value creation on average. So relatively small. And then very importantly, what we have seen in recent years is actually investing or underwriting behind expected multiple compression. So actually 14% decrease in overall value, again, just from the assumption that on average, multiples would contract by 1.5 to 2 turns. And so this is a really important note, that multiple expansion or compression being more of a market-based factor. And so this really just seeks to really prove out the point and illustrate the fact that the driver of return, which is typically a 2x or greater, 20% IRR or greater type of underwritten return, is over 90% driven by top line and EBITDA growth within the business. So lastly, let's spend a little bit of time on the exit environment. Now, again, going back to our comparison to public stocks, there's no ability to really position your holding in the public environment versus private equity, again, being patient capital, long-term in nature. There's multiple options for exit, but there's also ability to time the investment appropriately, but also position the company for the most appropriate buyer so that you can get the highest market clearing price. So just briefly, we've talked about the growth of the private equity market. This just gives some historical context for, by vintage year, the amount of unrealized value that's in private equity portfolios. Not surprisingly, more recent vintages, which are continuing to hold those companies and add value, they're not ready for sale. But as you go back 4 or 5 years, this really shows what we discussed in the prior section around longer holding periods. There continues to be trillions of dollars of unrealized value in older vintages that are ripe for sale. And we do think as the recent cooling of the market thaws, that many of these companies will seek either full exits or a separate liquidity event, as we discussed, perhaps a GP-led secondary transaction, for instance. So let's look at exit activity over time. And not unlike new transaction activity, where we saw a big uptick in 2021 and 2022, exit activity also peaked and more than doubled in 2021 relative to 2020. This was a terrific opportunity for investments that had been held for multiple years to seek new buyers. And we also saw the IPO and public market much more receptive to exits during that period of time. But it has since normalized and, in fact, decreased pretty considerably when you think about the context of the growth of the PE market overall. And the last 2 years, while relatively equal to levels that we saw from 2013 to, say, 2019, in the context of a much larger market with more private equity held companies, a very significant drop-off in exit activity. And the number of deals following a similar trend, as there were over 4,200 exits in 2021, and that's dipped nearly 50% to just over 2,400 just last year. So let's look at this in the context of buyout distributions. And this really brings together the reduced exit activity that we discussed on the previous slide. Now, historically, we would typically see roughly 20 to 40% of a beginning period's net asset value be distributed over the next year. So what this chart is showing is measuring distributions over the previous 12 months divided by what the beginning net asset value was, or the value of the current holdings 1 year prior. And while it will ebb and flow, historical norms are in the 20 to 40% range. And currently, over the past 2 years, we've seen extremely low distributions, historically low. Over the past 20 years, the only levels that we've seen at this rate were really post-global financial crisis, which you see the dip on the page in 2009 and 10. But over the past couple of years, distribution rates have decreased to about 10 to 15%. This is what's driven the push for more liquidity, the more challenging fundraising environment, but also just given how this cycles over time, we do believe that this is likely to thaw. And given the number of companies that are currently ready for sale, as that bid-ask spread narrows and really kind of bringing together a number of the different trends and points that we've discussed, we would expect this to naturally increase, but it does give context for just how low the exit activity has been, but also therefore how much the supply of potential companies has increased in recent years. So we're going to conclude today by talking about exits by type in the context of where private equity firms can really add value on the sell. Now, it may be surprising to some, but the IPO market or public market exit is a very small portion of overall exit activity. And in fact, generally speaking, most private equity held companies are sold to corporate acquirers or strategic acquirers. And this chart can be a little bit of an eyesore, but over time, typically about 40 to 60% of exits occur to strategic buyers. Now, corporates, whether they be large public companies or private companies, they're typically looking for three things to grow through acquisition: scale, profitability, and a product that will fuel their growth. So growth, scale, profitability. But that can take a lot of different forms. And even for small companies, it may be a specific product that really does help to scale part of their organization. And by and large, corporate acquirers don't want to do the hard work of dramatically improving the profitability of a company or repositioning and helping to grow the products. So it continues to be really the primary source of exit for private equity firms. And many private equity firms, particularly in the middle market and below, their strategy actually is to invest behind well-positioned mission-critical products and services and grow those companies and really position them to be an attractive asset for a corporate acquirer. So that makes up generally 40 to 60% of exits. And in the reduced exit activity we saw in 2023, it was at the higher end of that, making up 56% of all exits. The other exit tends to be other private equity sponsors. After a reasonable hold period, a smaller private equity firm who's executed their value creation plan and is now seeking to return capital to investors, it might make the most sense to have that company acquired by another private equity firm that's larger, that has a different set of resources and its own value creation plan to help take that company to the next level. And that tends to make up about 30 to 40% of exits in the environment. And last, and by far the most volatile, would be a public market listing. And so for many companies, the public market is not the right exit, but there are some that have the size and scale, potential market positioning, and unique nature that a public market listing could make sense. But historically, it's roughly 10 to 15%. We have seen periods of time where it increases dramatically, as we saw in 2020 and 2021. But generally speaking, it makes up a pretty unique and smaller set of overall exits. So in summary, we've discussed a number of points and different trends in the broader market context, but the overarching takeaway that I certainly hope you would get from today's session is that private equity firms, through active ownership and patient capital, can really unlock significant value both on the buy, during the hold, and even on the sell through how they position their companies using a number of different value creation levers. So thank you for joining us today, and we hope you enjoyed the session.